Greetings. I hope you all had a wonderful holiday season. We are back to put a bow on 2024 and look ahead to 2025. So this is our monthly video commentary. This month I'm going to change it up a little bit. We all can see that 2024 was a really good year despite the challenges around the election, inflation, interest rates, what the Fed was going to do, the AI theme. All of that equaled a pretty good year despite what folks were saying, including Wall Street. If you haven't checked out my Wall Street forecasting piece recapping what they said about 2024 and what actually happened, it was wildly wrong. And I say that not to pick on Wall Street, but no one knows what happens next. It's really hard to forecast a complex world. That said, we are looking ahead to 2025. I've got 8 graphs, 4 good, 4 bad. It's not a prediction piece, but some of the stuff that we're watching has our interest as we look ahead to 2025. So today is Monday, December 30th. Most of you will be getting this on Sunday, which is the 5th, I believe. So let's get into the slides. When someone asks me if I want the good news or bad news first, I usually say bad news first. So we're going to lead with the bad slides first, if you want to call them that. So this is a great chart from Vanguard. And basically what this is, it's outlining where various equity asset classes and factors, along with fixed income, where they were valued in September of 2023 and where they're valued as of November of 2024. Okay, so we have undervalued, fairly valued, and stretched. And the circles without filling are where we started in September of 23. The circles with filling, you can see those here where I'm pointing them out, are where we ended in November of 24. I'm not going to go through all of these. I'm going to go through the one that is most relevant to many of our clients and followers, and that is U.S. large cap stocks. So U.S. large cap stocks, for one, are trading at the most stretched levels in history. We're close to 99th percentile, meaning they're darn close to the most stretched levels in history. You can see where they started in the fall of 23 and where they're currently at now. We'll get in future slides what that actually means for future returns, but it's not good. So you can see some of these other equity asset classes. Most moved to the right, meaning they started undervalued and moved into fairly valued, or they were fairly valued and got less fairly valued going towards stretched, with the exception of value. So value is a factor that has our interest. It actually got cheaper, meaning it went from fairly valued to undervalued. Most other equity asset classes, factors, and bonds moved to the right because, again, it was a pretty good year. Most asset classes went up. As asset classes go up, they become less attractively valued. Bad slide number 2. We've touched on this before. This, some say, is the single best predictor of future stock returns. And I've written a few blogs about this. And it's very simple. So what this is, going back to 1951, is how much U.S. households own in stocks, how much they own in U.S. equities. And that's the blue line. So as the blue line moves higher, that means more U.S. households own U.S. stocks. The yellow line is subsequent S&P 500 10-year returns, okay? And this is inverted, all right? So as this line moves up, that means future returns are lower or even negative. So let's put these two together. As U.S. households own more stocks, you can see the last cycle peak was in 1999. Future 10-year returns were negative. That was the lost decade from 2000 to 2010. So at the start of that lost decade, we hit the cycle high for U.S. households owning U.S. stocks. Okay, what does that mean for today? Well, you can see we're approaching the cycle high for U.S. household ownership of U.S. stocks. We don't have a crystal ball into the next 10 years. That's why this stops. But if history is any guide, when this blue line moves up or peaks, future returns for the S&P 500 10 years out are usually flat or lower. Okay, so when you add the last slide up, we're stretched in U.S. large cap stocks, household ownership peak, future returns could be lower. The next slide further dives into this. Okay, so this is the S&P 500 forward PE ratio and future 10-year returns. Okay, so this bottom axis moves from cheaply valued over here, 8 times earnings, to very expensive over here in the bottom right. You can see where we're currently at, more on the side of stretched from a value standpoint. Up here is annualized total returns. And again, this is 10-year returns. So let's look at when US stocks are cheap, when they're trading at 8 times earnings or 11 times earnings, future returns are quite good. Future 10-year returns range from 12% to 20% a year. So when stocks are beaten down, future returns are better. Conversely, and where we're at today, when current levels are stretched, future returns are hovering around 0. Now, I don't mean to scare you. I'm just putting the pieces together, and I promise you we're going to get into the good slides next. But the story is if you're an investor in US large cap stocks and you've had a great run over the past 12 to 13 years, you would do well to revise your expectations down. The setup is completely different today than it was at the start of that really good run. At the start of that really good run, we were coming out of the financial crisis. Stocks were dirt cheap, future returns were higher. Today, we're at the end of that really good run, or closer to the bottom of the 8th, let's call it, of that really good run. Future returns should be lower. Now, the investment universe doesn't stop at US large cap stocks. There's other opportunities, if I can go back to this first slide, other opportunities, other asset classes that are cheap. I look at value, I look at small cap, I look at foreign stocks. So it's not like an investor can't earn a positive return. However, expectations for US large cap stocks probably need to come down. You need to be mindful of how you're exposed to risk factors and sectors and industries, and you might do well to spread and diversify your portfolio. Okay, the last bad slide. So this is the percent of S&P 500 by market cap for the top 10 stocks. It's a fancy way of saying the 10 stocks in the S&P 500 represent 40% of the index. So when someone is saving in their 401k and they're allocating money to the S&P 500, you might think you are allocating money in a diversified basket of companies, which is partly true, but it's becoming less true. So when someone blindly buys the S&P 500, if you're investing $100, $40 out of that 100 or 40% is going into 10 companies, which is great when those companies are going up, like 2023 or 2024. It's not so good when those companies are going down by 30% or 40% like 2022. So we point this out because the more top-heavy an index gets, the more fragile it becomes, the more concentrated it becomes to the fate of a handful of companies. So there's almost an animal spirit around a lot of these popular names, and I don't have to rattle them off to you. Most of you know what these names are. They've been driving a lot of the headlines, a lot of the AI theme, a lot of the performance for the index. We're not saying you can't own them. We're not saying they're not profitable companies. We're not saying that they can't produce positive returns going forward. What we're saying is an investor would do well to revise their expectations down. I don't make forecasts, but I can confidently say the last 10 years won't look like the next 10 years. So again, this is a really good time to kick the tires on risk, your sizing of your positions, not going overboard with any one company or theme. All right, now to the good slides. So there's been a lot of talk about a recession, what happens next with the economy. This has been going on since 2022 and 2023. So what this is a snapshot of the various business cycles published by KKR. So you've got a recession here in red, an early recovery in green, mid-cycle expansion in blue, late cycle in yellow. So this would be a yellow light, this would be a red light, this would be obviously a green light, and this is somewhat mixed. And what we're trying to capture is where we're at in the current cycle by various data points. So you see a lot of these filled in circles here are various data points, and they're classified by where they're falling in the various business cycles. I'm not going to go through each of these, but what I can say about this is it's very uneven. It's very mixed. There's not a boatload in contraction. There's not a boatload in a late cycle slowdown. That's a good thing. So what this is saying, in our view, is this is still a very jumbled, uneven cycle. It's not screaming recession. It's not screaming froth. It's very mixed. And I think that's important because, as we'll see with the next cycle, when the Fed is cutting rates and we don't have a recession, that usually bodes well for future stock returns. So economy not flashing anything concrete. Of course, this can change with an external shock, but by these various metrics, This is very much a mixed business cycle. If we're in a mixed business cycle and the Fed is cutting rates, future S&P returns tend to be pretty good. So what this is we're looking at the S&P 500 before a rate cut, 6 months before, 3 months before. Month 0 is essentially the rate cut by this dotted line, and then 12 months after a rate cut. All right, the orange line is where we're currently at. So 6 months before a rate cut, 3 months before a rate cut. You see it's been a little choppy, which is not abnormal, but it's been trending higher. Markets have trended higher before the Fed cut, when the Fed cut, post-Fed cut. Now, again, thinking of that last slide, mixed economy, not in a recession, Fed cutting. That's the blue line, all right? So if we get that backdrop, markets tend to do well. The S&P tends to do well, going up about 12% a year. Now, flip that. If we do get a recession and the Fed is cutting, markets, and this is not a surprise, don't tend to do well, negative about 12%. So if the current jumbled economy holds and the Fed cuts, even if it's less cuts than they predicted just a few months ago, that tends to be a positive backdrop for stocks. Moving right along, positive slide number 3. Okay, we got a mixed economy. Stocks tend to do well when the Fed cuts and we don't get a recession. The next thing is really a no-brainer. This won't get me on CNBC, but markets tend to want to go up. US stocks tend to want to go up. This is an itemized stacking by year of S&P annual total returns since 1928 through 2024. And we've got a question mark on 2024 because we still have a day and a half left of trading. But the statisticians would say US stock returns are positively skewed, meaning there's more positive instances than negative. So that's the first thing. And then the other thing is, just because a year is positive doesn't mean the next year is going to be positive. Just because a year is positive doesn't mean the next year is going to be negative. Returns are non-linear. They kind of bounce around, which again is not groundbreaking in and of itself, but I think it's important because a lot of people assign an overweight to what just happened. Like a lot of folks, Wall Street included, thought 2024 was going to be a bad year because 2023 was such a good year. Okay, a lot of people thought that 2023 would be a bad year because 2022 was such a bad year. So it's important not to get too invested in what just happened. Cycles change, and there's not a warning sign that says when they're about to change. Humans are really bad at predicting inflection points, when markets change. Okay, the other thing that I'll want to point out is, there's a lot of negativity out there. There's a lot of pessimism out there, and a lot of it's just to drive engagement, right? Eyeballs equals money in 2024. In the digital age, you have social media influencers, traditional media that get paid to sell ads. The more outlandish things that you say, the more eyeballs and clicks that you get. And what really captures folks' attention is saying outlandish negative things. People love a good train wreck. But be careful about that because look how infrequent some of these nasty markets are. So I always tell people, be careful about betting on the end of the world because it only happens once. Really ugly market events don't happen as often as people think. Now, that's not to say that you should go nuts and invest super aggressively because stock returns tend to be positive most years. It means that you should know what you're betting against. And, you see these ugly, crooked numbers, and it pales in comparison to some of the beautiful, crooked numbers on the other side. So again, we're not saying investors should get over their skis with taking on risk. Actually, we're saying the opposite given where we're at in the cycle as we open this presentation. But this is a really good time to make sure you're balanced. And we always say avoid the extremes. If you're super pessimistic, own some stocks just in case you're wrong. If you're super optimistic, own some bonds just in case you're wrong. Investors would do well to avoid the extremes. Okay, we've shared this before, and this is a comparison to the internet age back in the 90s with ChatGPT, the AI theme of 2022 to 2024, let's call it. And what we're showing is we're still roughly in the early days of AI, and the payoff is undetermined. What I can say is billions of dollars have gone into this. The end game is to be determined. There's still a lot of challenges with AI. Adoptability, the stress on the energy grid, the stress on data centers, the infrastructure, the cost, the payoff, all of these things are to be determined. But when you look at where this sits relative to Netscape, the internet boom of the 90s, it's eerily similar. And what this shows is we still could be in the early innings of the AI boom. And if this holds, certainly it's not without dips, which we've certainly seen with AI here. Here's a few where my mouse is. But there still could be legs left in this trade, in this theme. So there you have it. I couldn't fit everything I wanted into this presentation. You know, we have to be mindful of our editor and jamming this full of content. But I hope this is balanced. I hope this gives you some context to think about 2025. And I know each of you is different. Each of you has a different journey, a different risk profile. But we really try to give it to you straight. We really try to focus on the things that we can control. So if you're really confused about what happens next in 2025, know that you're not alone. Even the experts get it wrong. I was an investor and I am an investor. I focus on the things that I can control. I focus on how much risk that I'm taking. I focus on if my portfolio reflects the way that I feel about risk. I'm honest about my blind spots, about my emotional and cognitive biases. I'm optimizing the things I can control, like the tax efficiency of my portfolio, about tax drag, about fees. So all of these things go into how we manage portfolios. It's less on predicting what happens next and more about being prepared. So I wish you all a wonderful new year. May it be a prosperous year ahead. If you have any questions about our investment approach or how we work with clients, shoot us a note at insight@pureportfolios.com. We'll see you next month.